Welcome to The Debate. Analyzing public markets, it's often a lot like underwriting the construction of the Panama Canal.
Right. You're looking at massive upfront costs.
Exactly. You look at the blueprints, you see this sheer engineering marvel, and you just understand the potential to completely redirect global commerce. And it feels binary, right? Like, if they can just dig the ditch, well, they own the route forever.
Yeah, but what if the management team keeps telling you they have, exactly enough dynamite for the job, and then every 2 years they come crawling back to the banks asking for more? At some point, you really have to ask if you are underwriting a canal or if you're just underwriting an incinerator.
Yeah, and that tension right there is the core of our discussion. Today, we are looking at an investor analysis of AST SpaceMobile, ticker ASTS, as of the first quarter of 2026. This is a company trying to build the first space-based cellular broadband network.
I'll be arguing that their unprecedented competitive moat and technology justify the bullish thesis.
And I'll be taking the bearish view, arguing that management's history of missed timelines and just constant capital dilution makes the risk-reward profile, frankly, highly unfavorable for investors.
So, to really understand the leeway that investors give this company, you have to look at the scale of the ambition. I mean, the total addressable market, or TAM, is just staggering.
It is huge, I'll give you that, right? A $1.1 trillion global wireless market. We're talking about 5.6 billion mobile phones moving in and out of cellular coverage. To capture that, ASTS had to solve a massive physics problem.
And to be fair, for years, the primary debate among investors was simply whether the physics would even work. Skeptics, they argued you couldn't route broadband directly to unmodified smartphones from space.
Exactly, because cell phones have these tiny low-power antennas. So to catch that weak signal from hundreds of miles up in orbit, you need a massive ear in space.
Right.
That's why ASTS deployed Blue Walker 3, which is this colossal 693-square-foot commercial communications array. They essentially put a giant cell tower in low Earth orbit. And because they successfully proved that, the core technological risk of, can this actually work, is largely retired now.
I will concede the engineering feat is remarkable. It really is. But retiring the physics risk doesn't retire the business risk.
Sure.
My problem is entirely with how management translates these technical milestones into financial realities, because the current market consensus seems to be pricing in massive imminent cash flows based on their partnerships with mobile network operators. MNOs like AT&T and Vodafone.
Yeah, the tier 1 players.
Right. But if you read the actual Q1 2026 risk disclosures, you see a very different story than the victory lap that bulls are currently taking.
You're talking about the gap between preliminary agreements and definitive ones, right?
Yes, exactly. The company explicitly lists the risk of needing to negotiate definitive agreements that supersede preliminary agreements and memorandum of understanding. The fine print shows these are still just MOUs.
Okay, I see why you think that's a red flag. But let me give you a different perspective. Isn't an MOU with Vodafone or AT&T significantly more valuable than standard corporate letters of intent? I mean, given that these telecom giants have actively invested capital into ASTS,
well,
they aren't just cheering from the sidelines, They are equity partners with real skin in the game.
it's a fair point that it's more than a standard letter of intent. But look at it from their side. An equity investment from a multi-billion-dollar telecom is effectively just a cheap call option for them.
A call option, yeah.
They throw a little money at ASTS just in case the tech actually changes the world. But for ASTS, that cheap call option doesn't guarantee the unit economics when it comes time to actually sign the binding commercial agreements. And we really need to look at management's credibility here.
Right.
Because their historical track record on capital allocation is, frankly, deeply concerning.
You're referring to the timeline shifts since the original 2020 underwriting?
I'm referring to a systemic failure to accurately forecast capital intensity. I mean, let's go back to the December 2020 SPAC presentation, right? The vehicle they used to go public. Management claimed the constellation was fully funded and expected to be operating cash flow positive by 2023.
Yeah, that obviously didn't happen.
No, it didn't. Fast forward to the Q2 2022 earnings call. An analyst, I think it was Steve from Arizona, he directly questioned their funding runway.
Oh, yeah, I remember that exchange.
It was only then that the CFO, Sean Wallace, actually admitted they needed to raise additional capital before entering Phase 1 commercial service.
That was definitely a painful moment for early investors. The timeline undeniably slipped there.
It didn't just slip, though. The financial structure broke. They resorted to a $500 million shelf offering,
Right.
which, for anyone listening, a shelf offering essentially means the company keeps newly printed shares on standby to sell into the open market whenever they desperately need cash. That constantly dilutes existing shareholders.
It is tough on the equity.
Very tough. Cash balances wildly fluctuated. Imagine looking at your balance sheet and seeing cash drop from $400 million in 2021 down to $136 million by late 2023, while you're still just trying to get commercial satellites off the ground.
Look, I completely acknowledge that massive cash drop was terrifying for the market. And yeah, constant dilution is a really tough pill to swallow. But we have to look at why they are burning that capital and why investors keep funding it.
Because they keep promising the moon, or rather low Earth orbit?
Well, no, because the hardware required here isn't off the shelf. They're building a proprietary custom ASIC. This is a highly specialized, incredibly expensive microchip designed from scratch to process massive amounts of space-to-Earth data with very low power.
Which is incredibly capital intensive.
Exactly. That upfront R&D is brutal, but the original underwriting from 2020 projected 90+% EBITDA margins once the network is actually live.
If they hit those margins.
Right, but the unit economics are designed around a 50-50 revenue share with telecom operators for a simple text message sign-up.
Which is a frictionless onboarding process.
Super frictionless. If they capture even a fraction of those 5.6 billion mobile phones, hitting those margins on a wholesale network makes the interim dilution a necessary, albeit painful stepping stone. So the historical capital destruction might just be the harsh reality of frontier aerospace development.
Rather than a structural flaw in management's integrity?
Yes, exactly.
See, I struggle to give them that pass, because credibility is a key input into how the current debates will resolve. When things went wrong historically, their explanations always lagged reality.
How so?
Well, instead of adjusting expectations early, they held the line until their backs were against the wall. Like that Q2 2022 call, right? They waited until they were pushed before acknowledging the need for more capital. Because of that mixed record, you have to apply a severe discount to any forward estimates management gives us today.
Okay, well, if we pivot to those forward estimates, the next 12 to 24 months really act as the ultimate proving ground. The specific catalysts are the launch of the Block 2 Bluebird satellites and this critical transition from, investing in operational growth to actual commercialization.
Which is a huge pivot.
It is. The debate is rapidly shifting away from does the physics work to what does the cash flow actually look like.
And that is exactly my variant perception relative to the market consensus right now. Everyone is staring at the sky, waiting for the Block 2 satellites, but they should really be staring at the operating expenses.
You think the OpEx is the real story here?
Absolutely. While we wait for revenue to finally materialize, OpEx remains stubbornly high. We're looking at $91.2 million in Q1 2026. That is down only slightly from $95.7 million in Q4 2025.
Right. The burn rate is still significant.
Exactly. The real debate over the next 2 years isn't about satellite telemetry metrics. It's whether they can convert those telecom MOUs into definitive cash-generating contracts before the money runs out again.
And I think that circles us back to the core tension perfectly. AST SpaceMobile has proven the skeptics wrong on the foundational technology. They successfully operated a massive phased array in LEO, they secured the strategic backing of top-tier telecoms, and they are targeting an unparalleled market with potentially incredible unit economics.
While at the exact same time, the bulls have been proven consistently too optimistic on the timelines, the capital allocation strategy, and the speed at which you can actually transition from an MOU to definitive revenue.
Fair enough.
Management's historical forecasting errors leave this massive overhang that really forces you to question every forward projection they make.
While we both agree the technology is revolutionary, the continued disagreement really lies in whether the cost of realizing that revolution is ultimately going to reward shareholders or just endlessly dilute them. As this transition to commercialization unfolds, listeners will have to watch those upcoming Block 2 metrics and rigorously parse the exact wording of any future M&O contracts to decide for themselves.
It really does come back to your canal analogy. The engineering marvel is undeniable, and the blueprints prove it can be done. But as we look at the immense capital still required, the question remains, are we building one of the most valuable toll roads in history, or are we just funding an endless excavation?